Greetings to everyone striving to master trading and understand technical analysis. It's Oscar, a lead analyst at Binarium. In this video, we will compare 4 of the most popular trend indicators with practical examples. Simple moving average, exponential moving average, linearly weighted moving average, smoothed moving average. Let's start with the simple moving average. We have already analyzed this indicator in detail and tested it in practice in a previous video. You'll find the link to it in the description below this video. Now, briefly, SMA represents the average closing price over a given period. Its purpose is to smooth out price fluctuations, remove unnecessary noise, and indicate the overall trend direction. This indicator is best suited for long-term analysis and works well in relatively stable markets. The next indicator is the Exponential Moving Average, EMA. Like SMA, EMA averages prices but gives more weight to the most recent closing prices. Because of this, EMA indicator is more responsive to recent market changes, allowing for faster trend identification and more precise reversal points. Unlike SMA, EMA is better suited for short-term strategies and more volatile markets. Let's see how SMA and EMA work in practice. I'm opening a buy trade based on SMA since the price chart has crossed the moving average and is slightly above it. Thanks to the SMA signal, the trade closed in profit. Now, let's open a trade using the exponential moving average. We see that the chart has corrected, and the indicator suggests that the downtrend will continue. The EMA provided an accurate signal, profit secured. Next, let's look at the linearly weighted moving average, LWMA. This indicator is also sensitive to recent price changes, but it assigns different weights to different data points. Like other moving averages, LWMA can serve as a support resistance level, identify trend reversals, and help find entry and exit points. However, keep in mind that LWMA is also sensitive to market noise, so it should be used in combination with other indicators. Finally, the last indicator for today, smoothed moving average, SSMA. This combines simple moving average with exponential smoothing. Since SSMA is more smooth than other moving averages, it is less sensitive to short-term price fluctuations. This makes it useful for long-term trend strategies and volatile markets. Let's examine an entry point using SSMA. I opened a buy trade because the price is breaking out of a consolidation phase. The price is attempting to break a local high. The smoothed moving average is positioned below the chart. All these factors indicate that the price will likely continue to rise. Although the price growth was small, the entry point was well chosen, and the trade closed in profit. I'd like to emphasize that moving averages are among the most popular indicators in technical analysis. However, like all indicators, they should be combined with other analytical tools to confirm signals. For example, right now, you can see how a moving average is used alongside elements of graphical analysis. Let's summarize. The key difference between moving averages lies in their sensitivity to market changes, which determines their suitability for different types of strategies. Simple moving average and smoothed moving average are best suited for long-term and medium-term trading. Exponential moving average and linearly weighted moving average are more effective for short-term strategies. On the screen, you can see a comparison of the 4 indicators, including calculation method, the type of trading they are best suited for, and signal accuracy. Let us know in the comments which tools and analysis methods you'd like to learn more about. That's it for today. Like this video if you found it useful, and subscribe to the channel.